It's today. I want to bring in Thomas Hayes, Chair and Managing Member at Great Hill Capital LLC. Thomas, good to see you. Happy New Year.
Happy New Year. Great to be with you, Kristen.
All right, so let's get straight to it here. What is driving the market now? What does it mean for investors?
Well, there's a little bit of caution. You know, the market moved very aggressively into year end, and people came into the new year thinking that there was going to be this overwhelming amount of tax loss selling, and it was time to get immediately short. And I think you have to be cautious with that point of view. It's rooted in recency bias. If you zoom out a little bit, Kristen, what you'll see is that actually the stock market has made zero gains in over 2 years. So we had the huge move off the COVID lows into 2021. But since that peak in 2021, the market's been consolidating sideways for 2 years and just now starting to break out to new highs. So it would be normal to get a little bit of volatility and a little bit of consolidation after a big year. But when we look at election years since 1928, the average returns are 11.28%. And when you have an incumbent president running for re-election, they're 13. So I do think that even if we get a little chop, we do have nice upside into year end.
How is this impacting your investment strategy, Thomas? What are you buying and selling as we start the new year?
Well, I think that the gains last year were largely driven by the Magnificent Seven. The rest of the market started to participate in the second half and particularly in the fourth quarter. So I do think the Magnificent Seven, if you look at the Bank of America Fund Manager Survey, that's the most crowded trade. And if you think that the indices returns are going to be more subdued, high single digits, low double digits like we do, that implies that the Magnificent Seven will probably underperform relative to next year. Forward earnings on that group are well over 20 times if you look at the S&P. But the mid cap and small cap indices are trading at about 14 times forward earnings. So there may be some opportunities there. If you look at the fund manager survey from yesterday, what you also see is managers are underweight by 0.2 to 1.1 standard deviations relative to historic levels. Underweight banks, real estate, commodities, UK equities, and energy. So there are some selective opportunities there as well.
I do see jobless claims. Those are the number of Americans filing for unemployment benefits on a weekly basis. Actually, Thomas, dropping to their lowest levels since September of 2022. That we've got housing market data today. What is the economic data signaling to you in terms of the strength of the consumer?
Goldilocks. We had great retail spending. We did have, this is a good jobless claims report, but we have to keep in mind the non-farm payrolls reports, 10 out of the last 11 months have been revised down. The cumulative downward revisions have been 500,000. And then if you look at core PCE annualized, the inflation rate is right around the Fed's target at 2%. So I don't think the Fed can stay restrictive too much longer when you consider the Fed funds rate at 525, 550, and the core PCE annualized around 2%. That's 300 basis points of restrictive policy. I would not be surprised in the January meeting if they actually started to talk about tapering the taper or stopping the sales of bonds on the open market. And that would be a welcome respite for the market. And then rate cuts maybe starting in March or the meeting thereafter. But they've been tightening and restrictive for some time now, and they have to be cognizant of the lagged effect because inflation is a much easier problem to solve than deflation.
Yeah, that's good to note there. So the Fed had forecast 3 rate cuts this year, Thomas, at its final meeting in December, the last meeting that we've heard from the Fed with a policy decision as well. Do you think that that makes sense for this economy? And if we do get those rate cuts, when do you expect that they might start?
Yeah, I would, the prudent thing to be, the earlier they start, the less cuts they'll have to do. So the prudent thing to be would be to start at least by March. And if they do so, I think they're right on target. It may be 2, 3, maybe 4 cuts should be sufficient. If they wait because he's afraid of this Arthur Burns analog, which is completely non-comparable to the current circumstances, If they wait too long, then they might have to do 6 or 7, and they might actually force a soft recession. So earlier is better. You can always walk back if the economy heats up again. But if they go late, then you really do run aggressive disinflation risk and aggressive slowdown risk.
And I think probably investors may be agreeing with you, Thomas, as we do see the NASDAQ outperforming today, up 1% as the Dow does tick lower. Yes, of course. We are in earnings season. Earnings continue to come in here. But of course, we know that the NASDAQ would benefit, has historically benefited from lower rates, and that index rising a whopping 42%. Just last year alone. When it comes to the earnings picture, any takeaways that you're getting from corporate America so far?
Well, the secret to happiness is low expectations, Kristen. I thought the bank earnings were okay. But if you look at September 30th, the expectations were for 8% earnings growth for Q4. They came down to 1% earnings growth. So this is not a bar that needs to be jumped over. This is a bar that will be easily stepped over. And I think as we get further into earnings season, we're going to see continued upside surprises, which should give us a little more juice in late January and early February. And if we do move meaningfully to new highs on the S&P, that's when I'd start to be a little more cautious for a pullback in maybe March or April time period before starting out the year-end rally. Year-end move into year-end.
Let's just talk about some of these geopolitical factors as well, Thomas. What we've been seeing playing out in the Red Sea, obviously the ongoing war in Ukraine and the Middle East now as well. What are the risks that investors need to know?
Well, there's always geopolitical risk, and that's something you can't control. What you can control is buying high-quality companies that have durable, sustainable cash flow growth at reasonable prices, and just holding through the geopolitical noise, which is always going to be there, and you have absolutely zero control. I guess the key is, if you're buying right, try to put that out of mind, because more often than not, the fear of the outcomes are worse than the outcome, and it takes people out of stocks and out of great companies at the exact wrong time.
All right, Thomas Hayes, thank you so much for joining. Thomas is a chair and managing member at Great Hill Capital.